We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gary Savage, retired entrepreneur, stock and commodity trader, and founder of Smart Money Tracker Premium. Gary, how are you today?
I'm doing good, Tom. Thanks for inviting me back.
Always great to speak with you, Gary, and we've got a lot to go over today. But I wanted to start by asking you if most people are missing the big picture on metals. You know, you and I were speaking here this morning before we hit record about this idea of really instant gratification. And I think a lot of people can get kind of mired in the daily moves and, you know, just looking at the price day to day or even hour to hour. But why do you think most people are missing the bigger picture and what it means for the metals?
So I'm in agreement with you. I do think they are missing the big picture. And the big picture is we've got a breakout from a 13-year cup and handle basing pattern. And most people know the rule. The bigger the base, the higher in space. That is a huge base. And you can look at the long-term charts. You can look at that breakout back in, 2010, I think it was. That was about a year and a half base. And gold went up about 100%. This is a 13-year base. And this is why I say, you know, everybody's heard this before. $100 silver is going to be a piece of cake. I think $7,000 gold will be a piece of cake, but I think $10,000 gold is more likely. And it's simply based on the size of that 13-year base. It'll take a while to get there. I think it's going to be 3 or 4 months, or not months, 3 to 4 years at least, maybe 5 or 6. But I think it's going to get there. And I think the size of the base guarantees a move of that size. But I think people get kind of caught up in the day-to-day charts. So they're watching, and gold has been two almost 3 weeks now, kind of stuck below 2550, and they're getting frustrated, and they don't bother to pull up a multi-year chart and see that we've got, you know, this huge breakout back in March of this, you know, massive base, and I think we're still kind of in the first major leg up. That's probably I think it's probably get to 2,700, 2,800, and then I think we'll have some kind of a correction. But overall, over the next 4 or 5 years, the big picture, much, much higher, probably $10,000.
So, Gary, when we think about, let's say, the difference between the gold and silver charts, you know, obviously you're looking kind of at a measured move, as you said, from the base of gold. So does the silver chart make that, you know, a larger proportional move because of let's say, the structure of that chart?
Well, silver is a lot more volatile than gold. And one of the things that is characteristic of silver is it tends to move late in the cycle. So you'll notice when we get late into the intermediate cycle and gold's starting to get kind of expensive, then traders start to gravitate more towards silver because it's cheaper. And very often what will happen is you'll get this big explosive move towards the end of the cycle. And that's one of the characteristics we look for that tells us it's about time for a correction. You know, not a small correction, but a larger multi-week intermediate correction is when silver really starts to go ballistic over, you know, a couple of week period. A big percentage move over a short time period. That's a sign that the intermediate cycle is probably getting ready to top. And it's why I think silver is going to have a big explosive move here in, I'd say, by November, maybe ahead of the elections, maybe right after the elections. I think silver's probably going to go to $40, might get to $50. Might be a stretch to get to 50, but I think it could go to 40. But you're going to have to be patient because that big move occurs at the end of the intermediate cycle. And in the big picture, when gold goes to 10,000, I think silver is going to go to 250, maybe even as high as 500. But a lot of that will occur in the last year of the bull market during the parabolic bubble phase of the bull market.
Mhm. So Gary, we've heard a lot that the commodities complex in general needs to really rebalance or revert back to the mean. But why do you think the metals are really diverging from the rest of the commodity market at this point? As it seems like most of the commodities are in a correction at this point.
Correct. They are diverging. And I think there's a different fundamental driver for gold, especially, and then silver kind of follows gold. It has an industrial component as well, but it will generally follow gold. And when gold really starts to get overheated and going, to the moon, silver will follow, even though it does have an industrial component to it. But I think the driver of metals is different than just the commodity complex. I think there is a lot of it is being driven by the war cycle that is heating up. We seem determined to start World War III, and I think that's a big driver of it, along with inflation. But I think right now it's governments all over the world, especially Western governments, are really drifting towards more and more censorship, more authoritarian, and I think that's a big driver of gold in general.
Do you think the fundamentals really changed around August 2nd for the dollar, and in a way, by extension, for gold as well, by the Fed, coming out with that language of their Jackson Hole meeting?
I didn't listen to the Jackson Hole meeting. Now, I do think the dollar, well, it's definitely put in at least a daily cycle bottom, and it dropped far enough to tag the 200-week moving average, which it hasn't hit in quite a while. So this is a spot where we could get a bounce. We could get an intermediate degree bounce from this, or it could just be a minor daily cycle bounce that won't last very long and then rolls over and breaks below that 200-week moving average. I'm pretty much convinced that the dollar has started a secular bear market, but it's been stuck going sideways for about a year and a half, I think. At some point, it's going to break down from that sideways consolidation. I don't think it's going to go higher from there. I think it'll finally break down out of that box that it's been in, and we'll get an acceleration of the bear market in the dollar. But right now, it's a little too early for me to tell. It's at least in a daily cycle rally, maybe an intermediate cycle rally. If it is an intermediate cycle rally, I don't think it'll last more than 6 to 8 weeks before it rolls over, and then we do break below that 200-week moving average. So this will be it'll be another driver of the bull market in the precious metals, along with the war cycle.
So now that we've got that kind of that understanding, that overview explained for people, if you could, Gary, walk us through the gold chart to show us this bigger picture and why we need to take that into consideration.
So I think this is people get stuck in the day to day. They're only looking at their daily charts. They never bother to pull up the big picture. But the big picture is we've got this pretty well defined cup and handle. This was our 8-year cycle low right here. We're only a couple of years into this 8-year cycle, so we potentially have, I would think, at least 4 more years for this multi-year cycle to rally. Maybe, I think there's a decent chance that we get our bubble phase at the end of that 4-year cycle. And it might even last 5 years, and then we get 1 year down into the next 8-year cycle low. Could even stretch. But people are missing this. We've got a breakout from this 13-year base. We've got a breakout from this, what was it, 2.5, 3-year base. And then we've got a breakout from this, I think this was about a 3-month base right here. So they're focused on what's happening on the day-to-day charts. And in the day-to-day, gold's kind of been stuck for about, like I said, about 2 to 3 weeks below this 25.50, and they're getting frustrated. But the more times this 2550 resistance zone gets tested, the more likely it's going to break out. And when it does, all of the shorts that are trying to pin gold below that level are going to get squeezed, and it's probably going to break out with a big violent move. So I would caution people not to get too bearish right now. What happens is you get bearish and you give up and you go looking for something else to invest in, and then you miss that breakout move. And they always occur when you least expect it. And in this case, I think it's going to be a big violent breakout. So you want to be in before that happens.
Mm-hmm. Gary, do you see a possible, better buying opportunity for those that want to, get out of some of their fiat maybe and actually into physical metals?
I don't know that you're going to get much of a correction in metals right now. You may get $20, $30, $40 pullbacks, but this doesn't look to me like that we're going to get a correction like this, or well, this was a move down into an 8-year cycle low. Of course, this isn't due for another 6 years yet, but this is what an intermediate degree correction looks like. But we're not getting that anymore. This apparently was an intermediate correction here, but it just went sideways again. This was an intermediate degree correction right here, but it just went sideways. And we're just going sideways right now as we prepare to break out above 2550. So we're not getting typical intermediate degree pullback, something where you could wait and buy cheaper. I tend to think this is probably going to break out, probably going to go to somewhere between 2,700 and 2,800, and then maybe at that point we do get a recognizable intermediate degree pullback where you could buy cheaper, but I don't know that it's going to come back below the level that it's at right now. So even if you wait for the next intermediate degree correction, you may not get it cheaper than it is right now.
So again, Gary, if we could, can we look at the difference between the gold chart and the silver chart, please?
So silver chart, a little bit different. Obviously, we haven't broken out above the all-time highs, but that just means the base is, 2 or 3 times bigger in silver than it is in gold. So when we do finally break out above that $50 resistance zone here, and this is why I say a big chunk of those gains could come in the last year, a year and a half, when we get into the bubble. So we're kind of struggling with this $30 resistance here. We've got above it, but it came too late in the intermediate cycle to give us a sustained move, and then we've been in this correction. I think the intermediate correction is probably over. Right now, silver's in a daily cycle correction. Zoom in here a little bit, and here we go. Okay, so I think this is our intermediate cycle low, so I don't think we're going below that, but we are in a daily cycle correction here. So I don't know yet. It's a little too early to tell whether this is the bottom of the daily cycle correction and we're getting ready to make the next leg up. But I don't think we're going to break back below this. But the bigger picture, as you said, is we're struggling to break out above this $30 resistance zone. And once we do, then and I think we are going to break out above this on our during this intermediate cycle. And the fact that silver had this big, you remember I said that towards the end of the intermediate cycles, you get these big violent moves. The fact that we got this big violent move after gold had pretty much already topped in that intermediate cycle tells me that silver is setting up for a big explosive move. So I think we're going to, once we finish this daily cycle correction, I think we're going to get above 30. We're going to hold above 30. We're going to break out above 32. And I think we're going to have another one of these big explosive moves like we had like right here towards the end of this intermediate cycle. And it's probably going to take us to $40. And it might even take us to 50. 50 is probably a stretch, but I think $40 is pretty likely. And I think it's going to come probably somewhere between the beginning and middle of November, maybe even towards the end of November. So you're going to have to be patient here. We got to let this daily cycle run its course and then start the advancing phase. But I think you want to be buying physical silver here, because I think we're about to leave this $30 level behind during this intermediate cycle, and you're not going to be able to buy cheaper than that again.
Mm-hmm. So, Gary, when we're thinking about this bigger picture as we're talking about this, and really trying to consider this, when you're placing, let's say, a trade or an investment, whatever word you want to use here, are you buying for a longer term hold and just watching the charts, to instruct yourself as this is going up? Or are you looking for buying opportunities? How do you think about, placing this trade and or investment?
All right. So my suggestion to my subscribers is to have the majority of your capital in physical gold and silver. You won't be tempted to overtrade that. And you can see already this bull market is pretty volatile. Your stops get hit. Even, and let me go over to the mining chart, because this shows it really, really good. So you can see this has just been, we had a pretty easy phase to trade right here as we were making that breakout. But then it became really difficult. Then you had these big corrections, and then you get these rallies. And right about the time they get a breakout and everybody starts to think, to the moon, and this is where they want to pile in on these breakouts. Well, then we get another correction and a deep one. And so your stop gets hit and you get knocked out, and then you get a little nervous and you're afraid to pull the trigger. And you don't know where the bottom is. Maybe you get another fake out right here that you get in, and then the very next day your stop gets hit again. And then you get another rally, and you get a breakout above this pivot. And so now you're same thought pattern. Oh, we're going to the moon. You buy up here, and then back down we go. So this is kind of almost untradeable unless you can pick these exact tops and the exact bottoms. All you're going to do in a market like this that's very erratic and very volatile is lose money, even though the market is going up. It's going up slowly, and it's going up in such an erratic, volatile manner that trading it is almost impossible, and you're just losing money. So if you're in physical gold and silver, you're not going to be tempted to sell that. You will hold through all of this. Trading the miners, I've given my subscribers a way to try and trade this, because the general direction is up. It's just so erratic that trying to trade, especially with stops, you're just getting stopped out over and over. So I've given my subscribers a method to trade that. I'll just keep that information for my subscribers. Mm-hmm. But trying to trade this generally with stops, like most people will, and with the short-term instant gratification mentality that most traders have, then this kind of a market is just probably going to whipsaw you to death. So you need different strategies in this kind of a market in order to make money. Trying to trade these ups and downs is going to be very difficult, and most people aren't going to make any money.
Mm-hmm. Going back to the idea of, let's say, trading the gold and silver markets, are the commitment of traders reports a tool that you consider when placing a trade?
Not really. They are kind of a secondary confirming tool, but the COTs for gold and silver have been negative since, I think, late March. And I believe, if I'm not mistaken, they went negative at about 2,100 in gold. Now gold's at 2,550. So if you are using the COTs to construct your trading strategies for gold and silver, you've missed a huge rally. And generally the same thing for silver. So the COTs can be wrong for long periods of time. If everything else is lining up as being bullish, then I would tend to ignore the COTs. And that's what I've done because we've been in a bullish environment. At some point they'll be right, but you could, as I said, you've missed a huge rally if you're trying to use the COTs as a timing tool. They're not very good for that.
Mhm. And we're looking right now again at mining chart or GDX, right? Do you think that miners or let's say physical silver are a more favorable place to be considering the leverage when the metals moves happen?
I think you're going to make a lot more money. Now, I'll qualify this. I'll say a lot more money by the time we get to the top of the bubble in physical silver than you will in miners. You'll make a lot more money than you will in gold. The gold silver ratio right now, I think, is 88 when I looked yesterday. At the bubble top, it's going to go back down to 30. So you're going to make a lot more money in silver than you will in gold. And I think you're going to make a lot more money in silver, in your physical silver, than you will in mining stocks. Now, there will be a period, and it's basically, it already started back here when we broke out in March. The gold to mining ratio started to move in favor of miners, and it will continue to do that. I think it's been more or less hand in hand. Silver and miners have gone up about the same percentage, so they're both moving up at about the same pace right now. But as we get later into this bull market and as we start to move into the parabolic phase, silver is going to leave the miners behind, and I suspect maybe during the last 6 months of that bubble phase, the miners will start to diverge badly as they start to anticipate a top is coming. So if you want to really make the big money, I think you need to be in silver. It's going to be easiest to hold through these volatile back and forths. If you're in physical silver, you're not going to be tempted to sell during corrections. You're not going to overtrade it. But for the next couple of years, I think silver and miners both will probably perform at about the same degree, and they will outperform gold. But during the final year or so, you want to just be in silver, I think.
Mm-hmm. So obviously, as let's say the measuring stick for the metals, we've spoken a little bit about what the dollar is doing, but do you take into consideration, or do you try to look at as an extension of that dollar chart, what the other currencies that are important, let's say like the euro or the yen, to that dollar chart? Do you try to take those charts into consideration when trying to consider what direction the dollar is headed for?
So the biggest factor in the dollar index is the euro.
Mm-hmm.
The euro is going to go opposite of the dollar. The dollar is trying to bounce off of its 200-week moving average, and the euro is trying to get through its 200-week moving average to the upside. Also, I think the yen has it may have put in a secular bear market bottom recently. That'll also pressure the dollar to some extent. But as I said, I think the rally in the dollar, even if it's an intermediate degree rally, is not going to last very long, because I think the dollar, the secular bull market in the dollar, I think topped a couple of years ago. It's just in the process of breaking down, and once we break through that 200-week moving average, whether it be next week or 4 or 5 weeks from now, I think that'll be where the dollar really starts to fall apart to the downside. But right now, it's still kind of probably at least a daily cycle degree bounce, maybe an intermediate degree cycle bounce, but I don't think it's going to last very long.
Mm-hmm. So, obviously we're also, I think we're exactly a week away, as you and I are talking on Wednesday, the 11th here of September. And we're exactly a week away from this next FOMC meeting where Powell is likely to announce this rate cut, or the first rate cut for this cycle. Do you think that adds, more fuel to the fire here, or is the chart, just kind of predestined for this move?
Well, normally I would have said that the FOMC meeting would be the trigger event for the dollar to bounce. But instead, it decided it was going to bounce off that 200-week moving average. So it bounced off the technical level instead of the trigger event of the Fed cutting rates, because the dollar's been discounting the rate cut for a while now. And usually you would see a kind of in this case, it would be a buy the event instead of a sell the event, where the dollar would bounce when the Fed cut. So it would do the opposite of what most people would expect. But apparently that technical level of the 200-week moving average was strong enough to cause the bounce before the FOMC meeting. So at this point, we might actually get a sell the news event when the Fed cuts next week. The dollar may put in a daily cycle top in the dollar, and then we may go down and break below that 200-week moving average. And then at that point, it's game on in the dollar bear market.
And, when you say it's game on in the dollar bear market, what does this, condition also mean for inflation?
Well, I think we're probably maybe slowly rolling into a recession. So recessions generally are deflationary. That may be why oil is going down so aggressively. And most of the rest of the commodity markets are at least correcting. So inflation might be maybe on hold for a while until the Fed prints enough money to stop the recession and stop the deflation, and we get our next inflationary event. But because there are other factors driving gold, I don't think gold is going to really participate to the downside like the rest of the commodity markets are. But for right now, it seems like inflation is tempering a little bit. But at some point, if we do really start to get into recession, the Fed's going to respond like it always does, and then inflation is going to come roaring back.
Around that beginning of August timeframe, do you think the Fed's actions, as you said, we're slowly rolling into recession? Do you think the Fed's actions ended up affecting, let's say, the degree to which we're entering that recession?
Well, if they start cutting aggressively, I think they could slow it down. Unless you stop the war cycle, though, I don't think you're going to stop it. And as I said, I think, the neocons are pretty determined to start World War III. So it seems unlikely that we're going to be able to stop the war cycle. And if we can't stop the war cycle, I don't think we can stop the recession cycle. So it may be a slow process of rolling over into it, but I think it's kind of inevitable at this point.
And because of that, really that war cycle, and let's say the election volatility that we could see over the next 2 months, do you think that the markets are pricing all of the things that could go wrong into themselves yet? Or is the general market really discounting the amount of volatility that we could really see over the next 2 months?
So I think the general market has probably topped. If not topped, we might get a marginal breakout. Big cycle turns will often occur as either a false breakout or a false breakdown. We almost had a marginal breakout in the S&P a couple of weeks ago. It got within, a few percent or 0.5% of making a new all-time high, but then turned back down again. I was kind of looking for maybe a marginal breakout right there. And that gives the big money that kind of sees the big picture and what's coming. It gives them a chance to exit right at the top. And it's kind of a manufactured move. I don't know that we're going to get that marginal breakout at this point. But even if we do, I would be very leery of buying that breakout. I think it would be a false breakout. So I don't think we're going to get a big sustained move if we do get a breakout here ahead of the elections. I think it would be probably a bull trap where smart money is going to sell into that breakout. And so, if you're a retail trader, I would not get too bullish on a breakout. I would probably be, if you got 401 still in stocks, I'd probably be getting out of those stock positions and into a money market position or precious metals if you can do that. But I think the stock market's probably topped, or if it's going to make a marginal breakout, that's all it's going to be.
And really, as we're talking about, the S&P, you recently explained the power of regression in those markets. And you looked at this, I think it was a 10-year chart or something like that, that just, basically goes up and to the right. So explain that idea, if you wouldn't mind, the power of regression in the S&P chart.
So this is what I'm talking about when I'm talking about regression. When markets get stretched too far away from the long-term mean, this is a weekly chart. The red line here is the 200-week moving average. When the market gets stretched too far above the long-term mean, then you get a regression event. It can happen one of several ways. During 2020, we were due for a 4-year cycle low, and we had run out of time for that 4-year cycle low to progress. So it came as a crash, a short period crash into the 4-year cycle low. And then the Fed started more QE. They pumped it up again. And then we got, same thing, got stretched too far above the mean, and we get another regression event. This one takes about a year. I think this was probably a short 4-year cycle low. We are again stretched way too far above the mean. I think we're probably going to roll over again slowly into recession. So I suspect we're probably going to get a multi-year bear market regression event down into the next 4-year cycle low that will come down at least to this 200-week moving average, probably below it, probably below this, especially if we have a recession. But it may take out to 2026 or even 2027 to do it, because the Fed's going to fight this the whole way down. They're going to cut rates. They're going to start QE. So we've probably got a double top here, and we're going to start a regression event that could maybe bring us all the way back down to 3,000 or even lower, maybe even down to 2,000. But it's going to take a long time to get there, I think.
So no big kind of waterfall event because of the Fed fighting it.
I think we've run out of time. I was on the fence as to whether or not this was a 4-year cycle low, and we had the opportunity to have it here in September, but it just looks like to me this is probably not going to happen. This is probably it would have taken a geopolitical event, I think, or a massive natural disaster, a huge 8 on the Richter scale earthquake in San Francisco could have done it. If there was maybe some kind of a false flag event to bring Poland into the war and basically bring NATO into the war and ignite World War III immediately, that could have done it. Doesn't seem like either one of those are going to happen immediately. And it looks to me like this is probably our intermediate cycle low. So our timing band for that crash was now in September, and it looks like it's probably not going to happen. So I think now the odds favor just a long, drawn out bear market with lots of volatile and violent rallies as the Fed tries to fight the recession. So probably 2 years working our way down into the next 4-year cycle low and an unavoidable recession in the process.
Excellent, Gary. Well, I appreciate you walking us through all of these different charts and showing us how you see this developing. Is there anything that you'd like to leave our listeners with to think about or to consider before we wrap up?
Well, in my opinion, there's only one sector that I'm at all interested in, and that is the precious metal sector. I think it's going to benefit. It's showing that it's diverging from everything else. Try not to get too bogged down on the day-to-day charts. Keep the big picture in mind. We got a major breakout from a 13-year base. There will be periods of frustration, as we've seen, where the metals just go sideways. It's still doing that right now, going sideways, but the direction is up. So keep that big picture in mind. I'm not interested in energy. I'm not interested in uranium. I'm not really interested in Bitcoin, which has potential, but I think it's also in a cup and handle pattern. I think the handle has more months to go before we're ready to break out for Bitcoin. Not really interested in the stock market now. It's stretched too far above the mean. I think there's little chance of a sustained breakout in the stocks. So really the only sector, well, I guess you could invest in the defense sector because they are pretty much determined to start World War III. So I guess there's two sectors, but I would prefer to be in precious metals rather than investing in Lockheed Martin or Raytheon. But that's about the only sector that I'm really at all interested in or think that investors should be interested in. So just stay focused on the big picture, and I think you will do very well over the next 2 or 3 or 4 years.
Excellent, Gary. Well, I appreciate that advice. Of course, for anybody that wants to find more from you, your website, smartmoneytrackerpremium.com. And of course, excellent Twitter follow at Gary Savage1, right?
Correct.
Excellent. Gary, thanks so much for your time today.
Thanks for having me on again, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.